rally clearly has been fueled by FIs. So let's get one of them, Jan Den from Ashmore Group, is with us from London. Jan, hi, good morning to you in London. Would you have conviction to invest in Indian markets at current levels? We have seen foreign investors incrementally buy into India over the last few days, but at all-time highs, would that conviction stay?
Yes, I would absolutely do it. I would do it both on a tactical and on a long-term basis. There are essentially two broad drivers behind the rally in India. One is a global driver, and the other one is an India-specific effect. In the global markets over the past 12 months, EM has been beaten up really, really badly and been oversold. There is, in fact, no crisis in emerging markets. And what we're seeing in the data is that, contrary to expectations, developed markets are disappointing rather than emerging markets. And that means that after 12 months of sell-off, that there is considerable amount of value in emerging market assets right across the board, including equities, relative to developed markets. That's the first point. The second point is very India-specific. India has, over the past 12 months or so, engaged in significant efforts to stabilize its economy, which had become imbalanced. Although only a major macroeconomic imbalance, not any sort of crisis situation whatsoever. That stabilization process has begun to bear fruit, as we're seeing in the macroeconomic numbers. Secondly, it is likely, according to the polls, that we're going to have a material change in government, and that this government will have a significant amount of influence in the legislative area in Parliament. And that, of course, bodes well for reforms, and reforms is exactly what is needed in order to drive the Indian economy higher. In addition to that, we're likely to see, especially on the other side of the election, an economic upswing as people have been holding back spending power given the uncertainty that elections provide. So all of these factors do suggest that the market is right in pricing in a more bullish outlook going forward. It is not entirely without risks. Of course, you could have a disappointment in terms of the willingness of the new administration to deal with India's structural problems. But I think the bigger risk is that the weak data that we're seeing in the United States is eventually, probably over the summer, going to begin to give way to stronger economic data. And at that point, I would expect U.S. bond markets to begin to seriously sell U.S. Treasuries. And the resulting increase in real interest rates in the United States could put a dampener on the global appetite for emerging market assets, at least for a period of time.
I'm also curious, Jan, on how much of this confidence that you speak of is predicated on the view that the rupee will stay stable around the 62 level, and if it does move closer to the 64 level based on either dollar strength, etc., would your view considerably change on the Indian markets?
No, not for a little move like this. We are in a world of considerable currency volatility as it is, and I think smaller moves like this are not really that important. What I do expect is that the central bank, the RBI, will be quite mindful of what is happening in the currencies. India has secured quite a lot of benefit from the devaluation of the currency over the last 12 months or so, but India is also in a situation where a lot of its corporates have currency mismatches. So India is actually much more capable of handling marginally higher interest rates than a significantly weaker currency. But I don't really think that's where things are going to go. I think the broad direction is probably going to be for the currency to be pretty stable here, and in fact probably be under appreciation pressure as we go into the second half of this year.
Sanjay, so clearly, if Jan is any indication, or FIs are cutting their underweight position in India, getting positive in India, will those flows that come back in India, do you see large cap outperformance, or do you see mid cap also catching up?
No, I actually think that people shouldn't be too index focused. I think people should look at the individual companies and look at where they're priced relative to their ability to perform. I think too much index hogging is likely to run into problems. We've seen, particularly among large cap and mega cap type companies across EM in general, that some companies are more vulnerable to macroeconomic effects than others, and those types of risks can be shall we say, weeded out by a more active selection within the stock indices rather than a sort of plain index hogging approach.
Jay, what about some of these big stocks like Tata Steel and Tata Power? They're still down about 14% year to date. How would you approach some of these names now?
Well, I think investors should address each of these. You look at each of these names very carefully. If they have been beaten up, it's for one of two reasons. Either the fall in the price, in relative price, is justified because there is a fundamental relative deterioration in the asset, or it is simply mispriced. Asset prices in emerging markets, including in India, are frequently significantly mispriced for extended periods of time. And value investors that want to discover these types of opportunities need to get away from their screens, need to go and visit the companies, make a clear assessment of their ability to deliver returns to investors going forward, and then take a bet on the back of that rather than just sort of buying it because it's cheap. Cheap assets can mean that there's more risk. It can also mean there's huge opportunity. And the only way to really tell the difference between those two is to get out there and find out what's really going on in the firm.
Can I ask you about the downsides to this market rally? You laid out in one of your previous responses what you thought were 2 or 3 key domestic and global drivers to this rally. But for instance, let's say if the election results don't pan out to be what most of you are anticipating, or if we see big disruptions, let's say coming in from China or India, from the US, what are you building in terms of the potential downside to the Indian equity markets?
Well, I think there is a significant amount of bullishness, obviously, that has crept back into the market, and this does put a little bit of pressure on the incoming administration to deliver. There are strong bottom-up pressures for addressing various distributional issues in India, but there are also huge pressures to address some of the structural reforms. There are a lot of really low-hanging fruits in India. There are a lot of ways that a significant amount of growth can be unleashed with relatively simple reforms. The key issue, though, and I think this is going to be absolutely essential for the success of the next administration, is that that in order to balance both the demands for distributional initiatives, as well as the potential for raising growth and driving investment higher, it is absolutely essential that India draws in additional financing from the private sector, including private financing from abroad, because the government's finances are not particularly strong and need to be improved further. So the only way to really square this circle is to make India significantly attractive for additional investment flows, both from savers domestically in India that will then be more inclined to invest, and also to draw in more money from abroad. And a big part of that is actually about opening the Indian bond markets. India has a rather absurd situation that the equity markets are completely open to foreign investors, and we know equity flows can be very short-term and very volatile, whereas bond markets are largely closed to foreign investors. That's a point. A big change needs to happen.
That's a point well taken, Jan.